That's fine.
I am Paul Snow here with Snow Financial Group. I'm here with Charles Renwick. He is a CPA, a CFA, and also does analysis for businesses. If you ever want to sell your business and you want to know what the value of it is, he would come in and evaluate your business as well. But what we're talking about today is the Secure Act 2.0, which just came out recently, about, a week ago?
Yeah, just second to last week of December.
So this changes everything dramatically when it comes to retirement accounts, investment accounts, college plans for your kids, saving money on your taxes, multiple things where you could put money away, tax deferred, or even after tax dollars that will help you down the road for tax-free money. You want to go into a little bit about this, Charles?
Sure, thanks, Paul. I think it would first make sense to take a step back and think about the big picture when it comes to retirement accounts and the government's involvement with retirement accounts. In general, we have income tax as a society, and income tax, as a general rule, taxes all wealth creation. So the government has an objective to raise money, but they've now created another objective, which is to help people save for retirement and for education. And so they've got these two objectives, and they've created a system in which you can avoid paying taxes by properly saving for retirement and for education.
Okay.
And so their strategy is twofold: raise money and promote these things that are good for society, saving for retirement and college education. Does that make sense?
Yeah. So what Charles does, Charles would bring things like this to your awareness of what the tax code is. And part of my job is, after the fact, you put it into either a retirement account or a regular retail account or a college account for your kid. And I would actually take that money and make more money for you by investing it, depending on your age, your aggressiveness, or your timeline to when you need the assets down the road. But,
yeah, no, that's a great point.
Yeah.
And so just as an individual, always, in most cases, more money is better than less money, right?
Right.
So investing as individuals and as businesses, we invest for the future. We invest money today with the expectation that that money is going to grow and we'll have more money in the future. That's sort of the bedrock of our financial society. That's how people succeed with successful investments. And so if the plan is to have successful investments, why not combine that plan with a strategy so that you don't have to pay as much taxes? And that's where the government has come in and said, listen, if you do it in a certain way, you can actually end up with more money because less money goes to the government. Does that make sense?
Right.
Yeah. So they've had these types of accounts for a while now, but what we've seen is an increased focus on these accounts. And as you just mentioned at the beginning, we now have a very significant change into how these accounts function and the rules around these accounts. Because the rules, if you follow the rules properly, then you get all of these benefits. And if you don't follow the rules properly, there are penalties. Right. So we want to save, but we want to save in a way that we end up with more money than less money. So paying less money to the government is obviously an objective. And then where you come in is helping people decide what to invest in. And then where we work together is making sure that we fill out the paperwork properly so that, and we're aware of the rules so that it's done properly and we don't have penalties, and we maximize the amount that we can put, right, and then reduce the amount that we have to pay to the government.
Right, and that goes along. The more information I can gather from a client or a prospective person, the more that Charles and I could work together to really hone down in on your business model and know exactly what avenue to take to save the most taxes and make the most for your money down the road. Which brings me to back to the Secure 2.0. One of the biggest things that I got out of it was the new contributions to the 529 college plan for kids. And then if you don't use all the assets, what happens next?
Yeah, I would agree. This is, and I've said this before, this is a game changer to some extent when it comes to options related to tax-advantaged accounts. So there are two main types of tax advantage accounts, as you know, right? There's the account that is pre-tax, which means you don't pay tax now, but you pay tax later. And then there's after-tax accounts, which means you pay tax now, but then all of the growth is tax-free. Okay, so the 529 plan has been around, and the 529 plan was historically just for higher education. And so we're talking about college, right? And so it's an after-tax account, which means you put money in, you don't get any current tax benefit, but you get a tax benefit because all of the growth is not taxed. Does that make sense?
Yep.
So that's a pretty great option, right? It's a better option than just a traditional brokerage account, because traditional brokerage accounts, you're going to pay tax on the growth. But with a 529, it's similar to a Roth account. It's after-tax money that grows tax-free. So this is especially powerful if you have a long time horizon, because growth and income creation from investments is compounding. And so the longer you're able to keep money in an investment, the more opportunity has to grow. And then the growth compounds and creates even more growth. So you've shown these to clients, right? The models, if you put $10,000 into your kid's account when they're 1, how much are they going to have when they're 25? It's a lot of money, right?
A lot of money.
I can't think of it off the top of my head. What is that? But like if we have an 8% growth rate and we compound it over 25 years.
So little over 8 is the average over the history of the market.
Mm-hmm.
You know, so
but that's a compound rate, right?
Yeah, that's
right. So it
rate,
compounds.
yeah.
So
that's exactly right.
So $10,000 turns into 10,800.
Right.
But then the next 8% is on 10,800.
Right.
So it keeps growing and it grows, and it's exponential growth.
Yeah, so I always say it's not timing the market, it's time in the market. And the more time you have in the market, it's way more advantageous than waiting until you're 50 to try to put something in there when you're retiring at 65. It's just, you're kind of trying to catch up when you're a little too late, you know.
Yeah.
But, but with the 529, back to that, relating to the Secure 2.0, which just changed here a few days ago, they're now allowing you to put all your assets in a college 529 plan. If you don't use those assets, you can turn around and do a conversion or convert it to a Roth for yourself, or even convert it to a Roth for your kids, niece, nephew, grandkids, or whatever. It's a generational thing. So that will carry on down the road for a long way.
Yeah, and the popular press, if you look up 529 plans, there are articles about how 529 plans are very powerful saving opportunities for families, especially families that have a long-term time horizon. And so, but one of the main drawbacks has been this restriction to use for college. And so what we saw a few years ago was they expanded the use so that you can use it for K through 12. So if you have a child that is going to a private K through 12 school, you can use that money, $10,000 a year for that K through 12. Now you have this additional opportunity where if the money isn't used for college, you can put it into a Roth account and then just essentially convert it into a retirement account. And that's just a great opportunity, because all else equal, you'd rather have money in a tax-advantaged account,
right,
whether it's a pre-tax account or an after-tax account. This is an after-tax account. The problem is there are restrictions on getting money into these types of accounts. And so this is one less restriction on getting these monies into the account. So, everything goes well, you're able to spend the money on college, right? Another opportunity is to change the beneficiary. So if you have multiple kids and one of your kids ends up going to medical school, you can use one of the college funds, you can rename it, the beneficiary to the kid that is experiencing the high cost of education going to medical school. But if someone just doesn't end up going to college, you can put it in their retirement account. And so then they now have a retirement nest egg. I tell you what, if I had $35,000 put into my retirement account when I was 21,
right,
by the time I'm 65, do the math on that.
Tax-free.
Tax-free growth,
Yeah.
right? So 35 could easily be 35,000 40 years.
Right.
A 21-year-old, by the time they're, 61, that's $1 million.
Right. So the Roth has limitations right now based on your income. Most of my clients do not qualify for a Roth. If you're a dual income family, you're gonna get phased out of your contribution, which is only $6,500 now. If you're under 50, then another $500 if you're 50 and older as a catch-up. But what this 529 plan does, you could put more money in a 529, a lot, depending on the state, right? So every state has different maximum contributions per kid or per beneficiary. And then a lot of questions I get, what if my son or my daughter doesn't go to school? What if they don't go to college? What if they want to do a trade or something? And or what if they get a full scholarship and they don't need the money? This kind of answers that question completely. Okay, you just turn it and convert it to a Roth for yourself or for them, and then they could use it for their first-time home purchase in a Roth after 5 years, or they could use it for yourself tax-free down the road. It basically takes out all the questions that you would have regarding why all the other ends of a 529 and the back end possibilities that would go on.
Yeah, it makes it so this money's not going to get trapped.
Right.
There's always, with these plans and with all of the tax advantage plans, there are constraints, right? So the government has rules for putting money in, like you mentioned, like high income earners have less access to a Roth IRA. Now, right, they can access the same type of tax advantaged account, and after tax advantage account in the form of a 529,
right,
with no income limitation, right? So you can put individually $80,000 into each beneficiary's account. So if you have 3 kids, or if you have 5 grandkids, and you have money that you're trying to protect from the IRS, this is incredibly powerful opportunity.
And I think on top of that is you still have control of your money. It's not like you're giving it to the grandkids or giving it to your kids. It's still your money and still in your name. You have the ability to change your beneficiaries and do what you want with that money as you go along, any point in time that you want. If you even want to use it for yourself, you can.
Yeah,
so
worst
that's
case
huge.
Worst case scenario there, sorry to cut you off.
Yeah, no good.
Worst case scenario is that you pay a 10% penalty.
Right.
Right. So even the worst case scenario isn't that bad. You pay tax on the growth and you pay a 10% penalty on the growth.
Yeah.
So
that's not your contributions. You put $80,000 in there, that's already tax dollars. You don't have to worry about that. But any of the gains going forward, if you said you had to pull out, is 10% just on that.
Right. This is a great change, and this is just one of the changes. I would say, some of the articles that we've read talk about the Rothification of tax advantage savings account. There's multiple changes in Secure 2.0 that push people into these after-tax tax advantaged accounts.
Right.
Why do you think the government did that?
They want money now.
I think you're right. So the government is saying, pay us the tax now, and then we'll give you growth tax free. That's a big deal.
It's huge.
Right. So if you have a long-term time horizon, if you are the type of person that can benefit from saving, that understand the benefits of delayed gratification,
right,
if you can put money into these accounts now, if you believe in the long-term prospects of our economy, this is huge. Because that's part of it too, right? You have to have this expectation of growth. If you put money in and it doesn't grow, there's no benefit, right?
Right.
So only people that understand growth can really leverage this, right?
Right. And I think there's one other item that we haven't even looked at yet. You could tell me if I'm wrong or not, but when you make a contribution to a 529 plan, it's not the same as a retirement contribution.
Right, it's not. No.
So you could do the 529 contribution and then turn around and you can max out your retirement account. Let's say you're self-employed and have a SEP, and now you could put $66,000, get that tax deferral that you want, which lowers your bracket or lowers your income amount, and then still do the other one, which is tax-free, and there's no limitations on the other side. So that's huge. You still get the deduction or reduction, right? Right. And then you still get to do the tax-free going down the road.
Well, the other thing, when we talk about 529s, you just brought up so many topics that we can talk about, but a 529 the way that it works is anybody can contribute to it.
Right.
Right. So if we set up a 529 for the kid or for the grandkid, you can contribute to it, the parents can contribute to it, the kid can contribute to it. So if you want to teach your kids some lessons about money management, about saving, about working hard, right, you can give them a job. They can work for you. You can teach them some work ethic. Mm-hmm. You can make sure that they know how to stamp envelopes. Yep. You know, they can do some research for you. You can pay them. They can help you with your social media, right? You pay them, and then they can put the money into the 529. So they get, you get a tax deduction, right? They're in a lower tax bracket than you. Right. So you get this bit of tax arbitrage in which they're not paying any tax. You're getting a tax deduction, and then you can access this 529 so they can put the money into the 529, effectively saving for their own college, right?
So let's say you're self-employed and you have a 16, 17-year-old kid and you want to pay them. You pay them, I think it's $14,000 to max?
Well, there's a standard deduction. So you have the ability to pay your kids in a way that basically you get a tax deduction and they pay no tax.
Right.
Because people, low-income earners, right, which your kid would become,
right,
once you've paid them, they still have a standard deduction. So the standard deduction changes every year. But if they make less than the standard deduction, they don't pay any tax.
Right. So you pay them something, let's just say $10,000. You call it a salary for them. They turn around and take that money and they put it in a college 529 plan. They get it tax-free down the road. You get the write-off as an employer making employee income for a salary, and they get to put the money back into the college.
Yeah. So
tax-free.
I mean, what a great opportunity to teach a lot of lessons.
Right.
Teaching them about hard work, working for the dollar, saving,
right,
tax strategies around savings. Right. I mean, that really covers everything.
Yeah. And the contribution limits on a regular Roth are very low.
Right. 6,000?
Yeah, 6,000. And for if you're trying to do you can still do what's called a UTMA Roth, which if your kid's under 18 in this state, other states are different. You can still put money into an UTMA Roth for them at a young age, but you're limited to $6,000.
Right. So the question would be, why would you even want to do that if you now have this 529 option?
The answer is, there's no way in hell I wouldn't do anything other than that. You know.
Right. It seems like right now with this extra flexibility, 529 was already a great option. Mm-hmm. It's becoming more and more compelling, and it's hard to think of the reasons why you would do something else unless you already have too much money in the 529 potentially.
Right.
Right. So I mean, if you already have too much money in the 529, you're doing really well. Your kids, set up really well for college. You're looking for another opportunity. Hey, then let's look at these other things. But probably the first thing you're going to do is figure out how to fund the 529. Then we can look at, well, what if I set up a Roth account or an IRA account or a 401k for the kid?
Yeah, so if you're heavily funded, obviously your kids are probably not going to go to the money unless they're in some Ivy League school or some school that's
which is expensive.
Very expensive. But in most cases, that's not the case. But yeah, college is outrageous no matter where you go.
What did you say Alabama was?
Alabama was $48,500.
I heard Notre Dame was $80,000 a year.
$80,000, and it's all going up.
Right.
So this would be a case where you would, if you didn't have anything, or if you did have assets left over, or if you just want to use it as a tool as a flow-through tool, you can.
You know what I've heard, Paul? What's more expensive than going to college?
I don't know.
Not going to college. Right. So not going to college, obviously, if your kid, if you have the expectation and you want your kid to have the best chance of success, setting them up for the opportunity to go to college, there's no better investment.
Right.
And so if you're already going to be making that investment, and that investment's a smart investment for them and for you, because if they make a good bit of money, they can take care of you, right, when you get a little bit older. But if you're already going to be making that investment, why not do it in a way that reduces the amount of money that you give to Uncle Sam?
Right.
So you're being smart about it. You're being smart about a lot of things. You're planning for the future. You're planning for your kids' future. and you're doing it in a tax advantage way, I think that's just very compelling.
Yeah. If you got questions about college 529 plans or how it's tax advantage, let us know. Thanks, man.